This is Nightly Business Report with Bill Griffith and Sue Herrera.
October rout. The Dow falls more than 800 points, its worst decline in 8 months, and the sell-off was steep and it was sharp.
Tonight, your questions answered. What's driving the selling? Is this a brief stumble or something more? And what does it mean for your money, your savings, and your investments? You're watching Nightly Business Report for Wednesday, October 10th.
And we do bid you good evening, everybody. Investors with a memory know that October has traditionally not been kind to their portfolios in the past. Well, it has happened again this October, and today was the worst so far. Trading was ugly from the get-go. The opening bell rang, stocks dropped, and the selling intensified as the day went on. The Dow saw its biggest decline since February. The S&P 500 has now recorded its longest losing streak in 2 years, with more than half of the 500 stocks in the index now in correction territory, meaning that they are down 10% or more from their most recent highs. The cause? Well, there are plenty. Fears about rising interest rates, concerns over trade as the Chinese economy slows down, inflation and increasing cost pressures, and technology stocks, which once led this market higher. They've been leading the charge lower. In fact, as a group, they had their worst day in more than 7 years today. By the close, the major indexes were all down 3% or more, with the Dow plunging 831 points to 25,598. The Nasdaq was the hardest hit, dropping by 315. The S&P was down 94. And the sell-off occurs just as earnings season is about to arrive. And as Bob Pisani reports, that could bring a whole new set of risks to the market.
It was a sea of red on Wall Street today. The Dow plunging more than 800 points. Its worst one-day drop since February. Rising rates continue to fuel fears in the stock market, but some believe investors will be able to look past higher rates if the corporate earnings picture remains strong. That starts on Friday, earnings season. Right now, the earnings picture, well, let's just say it's getting a lot more complicated than it used to be. Investors are debating the impact of a large number of variables, principally higher rates, but then higher raw material costs, weaker foreign currencies, tariffs, and even potentially weaker demand from China. One thing's for sure, investor focus is shifting away from the third and even the fourth quarter earnings and toward 2019 projections. So what are the major issues to watch? First, margin erosion. That's the most important thing. That's mainly driven by higher costs, wages, and raw materials. Amazon's $15 minimum wage hike won't affect third or even fourth quarter earnings, but it has everyone scrambling to figure out what the impact might be on other industries next year. The good news is many companies may be able to pass on these higher costs to the consumer by raising prices. And revenues are still growing at a solid rate. That's very important. Up almost 8% this year, likely rise 7% or so in 2019. So if costs are up 2%, but revenues are up 7 or 8%, that'll go a long way towards supporting margins. The second issue is tariffs. So far, few companies have stated that earnings would take a direct hit from tariffs, but many are dropping hints along the way. Goldman Sachs estimates that a 25% tariff on all imports from China would shave off about 6% of the S&P earnings next year. That would essentially mean next year earnings would be flat compared to this year. Finally, we can't ignore the issue of higher interest rates. What's it all mean? For many, the risk-reward ratio still favors stocks. Nick Raish, who covers earnings at the Earnings Scout, told me when the economy is strong, stock prices will typically climb higher than the fundamentals suggest. That is what happened in 2000 and in 2007. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So let's bring in our guests for their take on today's big sell-off. Kevin Caron is the Senior Portfolio Manager at Washington Crossing Advisors. Jack Ablin is Chief Investment Officer with Crescent Wealth Advisors. And Timothy Lesko is our tech expert and a principal at Granite Investment Advisors. Welcome to all of you, gentlemen. Pleasure to have you here. Jack, I'm going to start with you. You think the big question is this just a blip, or is it the start of something that may be a little bit more significant? And you think it is perhaps the beginning of a correction?
I do. I think that underneath the surface, notwithstanding what Bob talked about with tariffs and all that, is a reset in interest rates that will change the dynamic between stocks and bonds. The fact is that over the last 10 years, thanks to central bank intervention worldwide, interest rates have been held too low deliberately to try to get investors to take on more risk. The good news is it worked. Now, central banks want to get those rates back to fair value, which means that the bond market will be able to pull on that tug of war with two arms. And that's going to put up a challenge to stocks.
Define fair value. What's fair value in the 10-year, do you think?
Fair value in the 10-year in my book is 4.5%, which equates currently to nominal GDP. Nominal GDP being real GDP at 2.2 plus inflation at 2. That gets me to the 4.5. And if before this whole experiment, if you will, with quantitative easing, the 10-year Treasury historically tracked nominal GDP.
Kevin, you maintain that the U.S. market and the U.S. economy is strong, especially when you compare it to economies and markets overseas, correct?
Yeah, if you look at what happened today, we're a little bit late to the party. Most of the rest of the world, think about Europe, think about China, think about emerging markets, are actually down on the year. The United States maintained some momentum, however, up until today. So today, what we saw was investors maybe finding value in other parts of the world that have gotten hit harder and maybe shifting a little bit out of the United States in that direction. We'll see whether that lasts. Our biggest piece of advice to investors is not to react to one day's trading, but look at really the broader set of data that's unfolding and use that really to guide your judgment. We think the U.S. economy still remains a leadership economy well into 2019.
Tim, the technology stocks began their decline well before the rest of the market did. Is that anticipating the slowdown in China, or is something else going on here?
I think it's a combination of factors. Certainly, the slowdown in China and tariffs on Chinese goods affects the tech sector in a way that it may not affect some other sectors. And then add to that, they might have been the most overvalued. So when the market resets, as the other two gentlemen talked about, certainly the highest flyers are going to have the most difficult days.
Now, Jack, as I understand it, you're not selling out your positions. You're kind of holding pat in the market. If that is the case, what are you going to be watching for as trading develops tomorrow and through the rest of the week?
Sure. So, I'm going to continue to look for this rebalance between bond yields and stock valuations. And yeah, I think our bottom line on equities is we see maybe a 10% downside. We've already endured some of that today. So for us, because we're longer term investors, this isn't something that we're going to necessarily sell out, try to get out in front of, and then get back in, especially with taxes and so forth, the embedded gains. Mm-hmm. But we would look for, continued downdraft as an opportunity to buy for, holding for the next 5 to 7 years. I would be looking for, more news on the earnings front. The fact is that earnings have been fantastic. And I think that earnings season generally allows investors to take a deep breath, get their wits about them, and really see what's important. And that's what companies are delivering.
Kevin, yesterday the president said that he was unhappy with the pace that the Fed was raising rates right now. Do you think the Fed will be rethinking their strategy if this market sell-off continues?
The Fed always looks at income data, and if things got materially worse, let's say, for example, investors began to pull away en masse from the market, or there was businesses and business judgment confidence became impaired, that would factor into their judgment. But this is too little for too small of a period of time, this downturn in the market today, to affect their judgment. And ultimately, at 2.25%, they're not especially tight. In past cycles, they were at 5.5% last go around in 2005 and 6 and 7, and higher than that before that. So they've got quite a ways to go, and I think they're doing the right thing.
Tim, you say that you've rotated towards what's called value tech, companies that don't need to take on a lot of debt. Give me an example of where you've been putting money to work in the value space of technology.
Oh, well, certainly, one of the hardest hit sectors of technology over the past few months has been semiconductors. Companies like Intel that have rock solid balance sheets, they have strong product cycles. Certainly, they've had a few issues with production, but if you're a long-term investor, these are opportunities to buy things that have been unusually punished in a market that was rewarding companies with light earnings and revenue growth and really hammering companies with strong balance sheets and maybe slower growth cycles. So higher interest rates will certainly hurt those companies that are being fed by debt, and help those companies that have strong balance sheets.
All right. Gentlemen, thank you so much. We really appreciate it. Kevin Caron with Washington Crossing Advisors, Jack Ablin with Crescent Wealth Advisors, and Timothy Lesko with Granite Investment Advisors. And a bit later in our program, we'll discuss how to protect your portfolio and what money moves, if any, you should make.
In the meantime, it may seem like a distant memory, but it was just last week that the Dow notched a record high for the 15th time this year. And since then, of course, the index has reversed course and prompted some to ask, has the market peaked? Mike Santoli takes a look now at how this market compares to the last time the market hit a top more than a decade ago.
This week marks 11 years since the stock market peaked just ahead of the Great Recession and global financial crisis, which ultimately would send the market to a 50% loss. It was a time that resembles our own in a few broad features of the economy and markets. Unemployment was low, oil prices were on the rise, the Fed had been raising interest rates for a few years, and stocks were at record highs. These parallels have some investors wondering whether it's time to brace for an oncoming end to this economic expansion and perhaps more difficult financial markets. For sure, the economic cycle seems to have entered a later phase right now, but the differences between today and 2007 seem more relevant than the broad similarities and suggest the outlook now is more encouraging. It's crucial to note that by October 2007, the housing market was more than a year past its peak, and piles of mortgage debt had already begun to sour, spreading losses throughout the global banking system. Credit markets had already begun signaling a buildup in financial stress months before stocks peaked. That's not what's happening now. Household finances at that time were more precarious, with consumer debt service obligations at a much larger percentage of income. And while right now Wall Street is struggling to absorb a fresh multi-year high in bond yields, this largely reflects a firm economy. Back in October 2007, Treasury bond yields were in a steep decline for months as investors viewed increasing signs of an economic slowdown. Indicators like the Purchasing Managers Index and small business optimism had peaked years earlier, in fact, in 2007, whereas today these are all right near cycle highs. None of this means the markets or the economy is entirely safe from a nasty economic surprise or a rough patch tied to a stumble in global growth. But all the same, the comparison of the current situation to the one 11 years ago is more reassuring than alarming. For Nightly Business Report, I'm Mike Santoli.
It is time to take a look at some of today's upgrades and downgrades. McDonald's was upgraded to buy from neutral at Guggenheim. The analyst cites the company's push into digital and investments in its franchises. The price target is $200. The stock fell, along with the rest of the market, to close at $168.37. Discovery was upgraded to outperform from neutral over at Credit Suisse. The analyst cites improved network ratings and distribution. The price target is $40. The stock fell about 1% to $32.06.
Dropbox was added to the focus list at J.P. Morgan, with the analysts there seeing the potential for 30 to 50% outperformance in that stock. Price target is now $35, and shares rose a fraction in an otherwise down day to $22.78. Kimberly-Clark, Clorox, and Church & Dwight were all downgraded to sell from hold at Deutsche Bank today. The analysts there cited near-term challenges like currency and emerging market volatility, and the firm also noted long-term headwinds like increased competition and retail pressures. And as a result, the shares of the three consumer products giants were all lower today.
Coming up, Monstrous Michael, one of the most powerful storms on record, slams into the Florida Panhandle, closing businesses, disrupting commerce and the local economy.
As expected, Hurricane Michael made landfall this afternoon in the Florida Panhandle, and this storm is punishing and fast-moving. And while it's way too early to say what the total cost of damages might be, Wells Fargo said today it could hit tens of billions of dollars. Courtney Reagan is in Panama City, Florida, for us tonight.
Hurricane Michael made landfall as a powerful Category 4 storm with wind speed of 155 miles per hour, just 2 miles per hour shy of a Category 5, making this the strongest storm to ever hit the Florida Panhandle.
We're very well prepared for it, massive amounts of food, and we have first responders all over. The electrical companies are staged and ready to go in immediately after the storm.
Power has been knocked out for at least 144,000 people as the storm continues through Georgia and the badly battered Carolinas, which are just recovering from Hurricane Florence. Businesses from local restaurants to big retailers like Walmart and Lowe's remain closed, going on more than 24 hours now. Home Depot also closed a distribution center in Georgia for the safety of its employees.
Treat this like a tornado. Get to your interior hallway or room, preferably one without windows. Get low, get in your bathtub, pull your mattress on top of your head, make sure you got a flashlight and a battery-powered radio, and sit tight until this is over.
Tourism is the big business in the Florida Panhandle, up 10% year-to-date ahead of the storm here in Panama City Beach. While it is the off-season, major beach erosion and area devastation could hurt the industry for months to come. The energy sector is dodging disaster as most major oil assets are west of the storm, including refineries in Mississippi. But crop destruction in Georgia is a concern. Only about 12% of the cotton crop has been harvested, half of the peanut crop, and the pecan harvest has only just begun. Fortunately, Florida's citrus crop is largely in the lower two-thirds of the state that's going to be spared by the storm. It's too early to get any accurate estimates of total economic loss for the storm, but that too could be one for the record books. For Nightly Business Report, I'm Courtney Reagan in Panama City Beach, Florida.
A key gauge of inflation rebounded in September. The Producer Price Index, a measure of the prices businesses receive for their goods and services, increased 0.2%. It was the index's first rise since June and was driven by an increase in transportation prices.
Well, certainly rising prices and inflation were some of the topics under discussion at the International Monetary Fund's annual meeting today. As we reported yesterday, the organization cut its outlook for global economic growth and highlighted a few critical risks to the market. Jeff Cutmore is at the annual gathering in Bali, Indonesia.
The IMF and World Bank may be holding this meeting in one of the most beautiful and picturesque tourist resorts in the world, but the message on the global economy is a little more cloudy. In the growth report, they've suggested that growth this year may slow from 3.9% to 3.7%, and they've also talked about rising risks to the financial system. This the result of the trade war between China and the United States, rising oil prices, and of course the pressure that we've seen on emerging market currencies. It is near term the risk of inflation that is causing some reassessment of the outlook.
Inflation at some point might surprise to the upside, in particular in the US. What we have seen so far is a very gradual decline in the unemployment rate to levels that are as low as we haven't seen since the 1960s. And of course, inflationary pressures might be building at some point, and that might lead to a faster than expected tightening of monetary policy at some point in the future.
One of the other stated key goals here at this event is to put on a united front over the trade dispute. The IMF, the World Bank, the WTO and the OECD all coming out and saying we need a de-escalation of the trade dispute and we need to wind back the introduction of tariffs that are increasing the likelihood of inflation and would ultimately lead to that lower growth that has been forecast. This is Jeff Cutmore for the Nightly Business Report in Bali.
The Justice Department approves a merger A mega merger at that. That's where we begin tonight's market focus. Antitrust regulators today gave the green light to the $69 billion merger of Aetna and CVS. The planned sale of Aetna's Medicare drug plan to WellCare resolved government antitrust concerns. The acquisition is among the most significant in the healthcare industry in the past decade. Aetna shares were off just a tick to 203.41. Shares of CVS fell fractionally to 78.92. Tobacco giant Altria may be thinking about buying a stake in a Canadian marijuana producer. The Globe and Mail reported that Altria is considering a minority investment in Altria, with the possibility of a majority stake a little bit later down the road. Altria's shares finished down just a fraction to 62.91. Myriad Genetics has been hired to conduct testing for Pfizer's treatment of what is called triple-negative breast cancer, which has fewer treatment options than other types of breast cancer. Myriad specializes in testing hereditary cancers. And on an otherwise big down day, shares of Myriad Genetics popped nearly 4% to 44.86.
Industrial component maker Fastenal faced higher costs in the most recent quarter, and as a result, the company's gross margins suffered and the stock fell despite reporting slightly better earnings per share. Fastenal shares were down 7% today to 51.67. Cybersecurity firm Imperva said that it is being taken private by equity firm Thoma Bravo for more than $2 billion. Under that deal, Imperva will be given 45 days to solicit other acquisition offers. Shares of Imperva popped nearly 28% today to $55.11. And another warning late today, construction firm Fluor said that revenue for the quarter is going to miss Wall Street's estimates. Fluor will release final third quarter results on November 1st. Shares initially fell in after hours tonight, also finished the regular session down 4% to 56.22.
Coming up, how you can protect your portfolio after a steep sell-off like today's. This evening, President Trump was asked about the stock market sell-off and pointed fingers at the Federal Reserve.
Actually, it's a correction that we've been waiting for a long time, but I really disagree with what the Fed is doing.
The president has been critical of the Federal Reserve recently, saying that the central bank is moving too aggressively in raising interest rates.
Also late today, a judge granted chemical maker Monsanto a new trial following a landmark verdict earlier this year. The company was challenging a ruling that ordered it to pay $289 million to a man dying of cancer, which he says he got from using Monsanto's Roundup weed killer. Monsanto, which is now owned by Germany's Bayer Corporation, had denied that Roundup was responsible for the man's cancer, and now there will be a new trial.
Investors are not putting as much money into some of the world's most popular investment products. According to Morningstar, net inflows into passive investments like mutual funds and exchange-traded funds are down more than 45% through the first 3 quarters of this year compared to last year. One market watcher says the data makes it feel like investors are in the early stages of positioning themselves for a potential downturn.
Okay, so after a day like today, many investors no doubt are wondering what should they do with their money now. Nancy Tingler gets to answer that question tonight. She's Chief Investment Officer at Heartland Financial. Nancy, always good to see you. Thanks for joining us.
You too, Bill. Thank you.
I guess part of the answer comes from what you think the market's going to do. And you think we were eventually heading for a bear market, don't you?
Well, yes, I think we still have a year to 18 months, depending, based on what we know today.
Right.
But yeah, it's a prudent time to start taking some risk out of your portfolio.
So what have you been doing for your clients? How do you decide and how do you determine what to take out of a particular portfolio?
So I think one of the first places to start is to trim the growthier more growthier holdings in your portfolio. So these would be names of companies that that are trading at high price to earnings multiples do not pay a dividend, for example, and replace them with value stocks these are companies that pay dividends and are growing the dividends out of free cash flow. And so that would be companies like Chevron, JP Morgan, Johnson & Johnson, even an Apple is a company that's attractively valued even at these levels.
But it sounds like you wouldn't like some of those technology stocks that have been high flyers, have high priced earnings ratios, and don't pay a dividend, right?
That's correct.
Yeah.
Yep.
So then what are these value companies? I mean, you were talking about an infrastructure fund that you've been looking at since the beginning of the year. What is that about?
Yeah, so the other thing you want to do is take some of the correlation to the stock market out of your portfolio. So a good global income and currency fund, pretty low correlation to anything that goes on in U.S. stocks. Infrastructure tends to act a little differently than the stock market, and particularly if you think that the Democrats are going to take control of the House, we might get a great infrastructure bill out of Congress. So those are ways to protect your portfolio against the volatility. But I would also be letting cash accumulate as you sell your winners, and really look for those companies that are franchise leaders in their industry that can grow free cash flow and the top line. Companies like Home Depot and McDonald's are growing the dividends 22% and 15% annually, respectively. Those are the kind of companies that will provide protection in a declining market period and have the opportunity to appreciate.
And I see you say maybe a global bond fund. Would you go into the short end of the bond market, like the 2-year or the 3-year?
Yeah, well, so in the U.S., I would absolutely do that. Globally, these funds have the ability to troll the globe, looking for the best currency return, the best bond return, and so they make that decision for you. But yes, Sue, if you're going to be buying bonds in the U.S., you want to be shorter than the 10-year at this point in the cycle.
Very good, Nancy. Always good to see you. Thank you, Nancy
Thank
Tengler
you.
with Heartland Financial, joining us tonight.
Here's another look at the day on Wall Street. Big sell-off. The Dow Jones Industrial Average down 831 points. The NASDAQ down 315. The S&P was down 94. Let's see what tomorrow brings.
Indeed.
That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.